Paying the right price for a growth stock is perhaps the most rewarding play in the stock market, leading to the biggest and fastest gains. It is difficult though. Growth stocks are more often than not in the infancy of their business development. They have unclear addressable markets, unproven profitability, and uncertain growth trajectories. In this video, I will share with you a simple way to value growth stocks, and I will take as a case example Trulieve, one of the biggest US cannabis companies. This is an educational video and I'm sure you will get a ton of value out of it. So be sure to smash the like button and subscribe if you haven't. Let's dive into it. Growth stocks are obviously companies increasing their revenue or profits at a rapid pace, and often they do that when they are in the infancy of their life cycle. Once they establish themselves in their niche, revenue usually slows down and the management team starts caring more about profits and defending their established position. Eventually, their competitive advantage fades out, and the company starts a negative spiral which leads to a decline. Valuing mature and old companies is fairly easy. In mature companies, the future profits are often easily predictable, and discounted cash flow valuations work wonders in determining the intrinsic value of the business. In declining companies, you can spot value opportunities by looking at the assets they have accumulated over the years, how much profits they can make before they become totally irrelevant, and then finding arbitrage opportunities there. But what about the early stage growth companies? I will now show you how to value an early stage growth company in a super simple way. I will take as an example a cannabis company because it fits perfectly the growth company stereotype. The cannabis market is still in its infancy, where in many states in the US is still fully illegal or partially illegal. It is also a market growing at extremely rapid pace. We will take as a case example Trulieve. Trulieve produces, processes, and sells cannabis related products in the US. The biggest market is the medical cannabis market in Florida, but thanks to acquisitions and organic growth, it is expanding rapidly to other US markets. I made a video looking at the fundamental of Trulieve, and if you are interested, I leave that in the link in the description below. So let's value Trulieve. Step number one in the valuation is defining what is the total market opportunity for the company. Step number two is defining what will be the market share of the company. And step number three is to figure out how profitable the business is. Number four is to predict future profits. And finally, number five is to give the business a value. As you move from step number 1 to step number 5, you can see that you are zooming in the business, starting from the broad perspective of the market size and zooming in then in the details of the company, how much money it will make and how much money it will therefore be worth. Let's dive into an example, starting from step number 1, defining the total market opportunity. The US cannabis market was $17.5 billion in 2020, and the analysts are predicting it to grow all the way to 80 billion in 2030. That is more than a quadruple in 10 years. The numbers in red is what we know for certain, and last year Trulieve controlled 3% of the US cannabis market, achieving $522 million in sales. In such a fast-growing market, many companies will grow unless they are mismanaged, and we know that Trulieve has a management team that has an amazing track record. The question is, when the market will become 80 billion in 2030, which percentage of that will belong to Trulieve? This is step number 2 in the valuation process. And to answer that question, it matters how well we know the fundamental of the company and how much you believe in it. In the case of Trulieve, I believe it will very likely become a winner and will steal market share from others due to organic growth and mergers and acquisitions. However, it is also important to make these predictions as unbiased as possible and even slightly bearish to keep the estimates conservative. Therefore, I chose to keep the 3% of the market share, meaning that the company will grow just in line with the market. Multiplying the market share by the total predicted market size will give us the predictions that Trulieve will generate $2.3 billion in sales in 2030. Now we move to the third steps in the process, determining how profitable the business will be. For this, we look at operating income margins. This is a measure of how much money the company keeps as profits after we factor in the cost of producing the product as well as running costs that the company has, like inventory costs, R&D, salaries, building maintenance, etc. When we look at the landscape in the biggest US companies, we can see that operating income margins range from a high of 30 to 35% for companies like Trulieve and TerraSend to a low of 10 to 12% for companies like Cresco Labs and Curaleaf. There are a number of reasons why these margins vary so much from one company to the other. One explanation is, of course, that the business models change from one company to the other. For example, Cresco Labs is focused on wholesale consumer packaged goods. This allows them to have high volumes but lower margins than a company like Trulieve that sells more premium products. Another reason is simply how efficiently the company is producing the goods and running the business. But nevertheless, this exercise here gives us an understanding of where margins are likely to fall in the industry as a whole. And this gives us a starting point for predicting where margins will be in 2030. There are two more considerations I want to make. One is that margins are likely going to get better as the industry as a whole matures, because you can achieve economy of scale. Also, as the company itself matures, the management will become more focused on profitability and efficiency. So it is likely that the margins in the long run are going to get better than this. But once again, when I make predictions, I want to be as conservative as possible. So I will stick to these numbers over here. With that said, we have the high side of the operating margins in the industry around 32%, average margins at 23%, and low margins at around 12%. Let's now move to step number 4, predicting how much profits the business will generate in 10 years down the road. Taking the margins we just discussed, we will have Trulieve generating 763 million in operating income in 2030 if the company managed to keep the 32% margins, and 548 million if the margins will fall to 23%. Over here, we have the graphical representation. As I said a minute ago, I believe that these are quite bearish estimates. I believe margins will keep above 30% and perhaps even improve in the future, but I like to keep the predictions conservative. Step number 5 is where we retrieve the business value. By multiplying the predicted operating income that we calculated in this table, based on the two margin scenarios by an appropriate multiple in this row, we get the predicted market capitalization in the business in the year 2030. The reason I chose this range of multiples from 10 to 30 is because these are the multiples I would expect if the sentiment is very negative, around 10, and if it is very positive, around 30. Right now the sentiment is negative and Trulieve crashed about 50% from the peak, as you can see here. The multiple right now is 14 to give you a reference point, but it has been 30 in the past, so I think this is a reasonable range to expect. This means that in the most bearish scenario where operating income margins will shrink to 23% and the multiples will fall to 10, the predicted market cap for the company will be 5.4 billion in 2030. Whereas if margins will keep at 32% and the multiples will increase to 30 in a bullish environment scenario, we could expect the market cap to surpass the 22 billion mark. Given that the current market cap when I make this video is around $4 billion, this would give us the following upside potential that you see in this table, from the most bearish projections of plus 43% to the most bullish of plus 496%. Consider that the S&P 500 benchmark will have a 145% potential, considering that the historical growth rate is 10.5% per year. I love this because, as you can see, the only way you cannot beat the S&P 500 is if you are in the most bearish case, and even in that scenario, there will still be an upside. In my opinion, the most likely case will be something around this point. As I mentioned earlier, I think the company will achieve economy of scale efficiencies and margins will expand beyond 32%. And also the total market share of the company that we kept at 3%, if it expands as I would expect it to be, it will have an important influence on the valuation. Let's actually for fun play around with these variables and predict that the market share of the company will increase to 7% in 2030 as a proxy of how well they will execute. And let's imagine that the margins will increase to 37%. I don't think this is unreasonable whatsoever, but you can see how the valuations starts going bonkers. I love when I find these investment opportunities because they give me an asymmetrical risk to reward. The risk in the worst case scenario is limited, whereas the upside is off the charts. In conclusion, I showed you a super simple workflow of how to value a growth stock that doesn't have yet a stable income and cash flows. I believe these exercises are very valuable because it is where you can find the absolute best investments for high return. I also think that this is a huge psychological help because you can picture what the bearish case scenario is, and therefore it helps not to panic when the sentiment is down and the market goes nuts. It helps sleeping well at night. We use Trulieve as the case study in this video, and I love Trulieve, and it is one of my bigger investments in the portfolio. I hope I could convey to you why, in my opinion, this is an asymmetrical risk to reward investment, where the downside is limited and the upside is huge. As always, though, I must say out loud that I'm not a financial advisor, and this content is not financial advice. I hope you learned something new in this video, and if you did, smash the like and consider subscribing. See you in the next video. Before we go, I must remind you that I'm not a financial advisor and this content is not financial advice. It's just my opinion and you should do your own due diligence before investing in any product. Have a great day.